Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. Thanks for joining me today. Today's episode is the first in a three-part series that I'm doing in conjunction with Nationwide and the Nationwide Retirement Institute. And I have with me as my guest, my brother, Stephen Calandra, who's the vice president for Nationwide in the Retirement Institute. He's been with them for 8 years. This is going to be the first in a three-part series. Today, with my brother Stephen, we're going to talk about tax-efficient retirement income planning and talk about Roth IRAs in the next episode. And then lastly, health savings accounts or HSAs for the third part. So Steve, thanks for taking some time to speak with me today.
Happy to be here, Chris.
So the Retirement Institute that Nationwide has, I've been in the business 29 years. So I've seen a few things along the way, but I think that the Retirement Institute is so innovative and such a special part of what Nationwide offers to the advisor community as well as to their clients. So can you talk a little bit about the mission of the Retirement Institute?
Yeah, the Nationwide Retirement Institute has been evolving since about 2008 to 2010. And what we do is we kind of fulfill the mission of the parent company. So Nationwide has a mission, which is to protect the people, businesses, and futures of everyone that you care about as a financial professional, our members, with extraordinary care. So they created a non-product facing division of Nationwide, thought leadership division, if you will. And we are tasked with breaking down and simplifying some of the macro issues that retirees face. And we do this by bringing education and insights to the market. We offer free reports and tools that financial professionals and plan participants can use throughout the financial planning process. And then we offer ongoing consultative support, because it's our hope that whenever we come out and we do a podcast, webinar, seminar, group meeting, that it's the beginning of our conversation together from a consultative approach and not the end of the conversation when we part ways.
So that's great. And this three-part series that we're doing, tax-efficient retirement income planning, Roth IRAs, and health savings accounts, this is an expression of that educational thought leadership from the Retirement Institute that we're going to take advantage of here at the Simply Financial podcast. It's going to be some great content, I think. So you are the first of the three, and we're going to talk about tax-efficient retirement income planning, as I probably already said 5 times. So can you give just an overview of what we're thinking about as financial geeks? I consider myself a financial geek. I think you qualify too, right?
100%.
So talk a little bit about what we're talking about at a very high level when discussing that term.
Yeah. You know, at the beginning of the Nationwide Retirement Institute, they had this program that was called Retire Sense, which was supposed to be an overarching theme above what the Nationwide Retirement Institute would kind of think about. Eventually, they retired that program and they replaced it with this concept of tax-efficient retirement income. In other words, how can we geek out financially from trying to figure out how to serve your clientele, right, the public at large, by helping them have the highest income in retirement with potentially the lowest tax liability?
That makes complete sense. You know, when we speak with clients with LE Wealth Management, existing clients, and trying to attract clients, Steve, you know, we talk about a lot of our work occurs at the intersection of investments and financial planning along with tax planning. And you get, if you can do it correctly and thoughtfully, you can get terrific outcomes if you're investing money wisely, doing terrific financial planning, and being tax sensitive whenever, wherever possible. That's kind of what we're talking about, just expressed a different way, right?
That's exactly right. And if we were to compare the two different models that we might discuss, that really gives us the crux of the entire conversation. Because if you think about when you entered the industry or when I entered the industry, what did most people do, right? They would accumulate some non-qualified assets, but by and large, because they had time on their side, the old model said, do everything you can to prepare for retirement while the law of large numbers is on your side. Okay. So now what we have is we have an older model where there's a lot of folks that are out there that are heavily weighted in qualified accounts, which is a good thing, not a bad thing. They may have a little bit of non-qualified money that is taxable on a year-by-year basis. But as time has gone on and our careers have evolved, one of the things that I know you and I enjoy so much is the fact that there's other opportunities in the financial planning process, a set aside from just investing, that allows you and allows one to do really cool things with retirement. And that's where the concept of a tax-free type of bucket comes in. So now we have an old model, a lot of overweighting in qualified accounts, a little bit of non-qualified money, taxable money. But now we have this new model where we can complement both of those with a third bucket, which would be kind of like tax-free. And that would be your Roth accounts, cash value life insurance accounts, HSAs, as you'll hear from Dave Harris later on.
Beautiful. And when you say qualified accounts, just to make sure everybody is on the same page, listeners, qualified accounts, probably the central example would be 401ks, but it would also include IRAs that you took a deduction for, old pension plans, retirement accounts that you might have lump sum monies in retirement accounts at either current or old employers. That's a good definition, right?
Absolutely. Did you say IRAs in there too? I might have missed it.
I did say, yeah, pre-tax IRAs, because we're going to, as we get along, we're going to talk, listeners, about Roth IRAs. Now, there's traditional IRAs, which are pre-tax, where you took a tax deduction for them more often than not. And then Roth IRAs, we'll talk about that distinction here in a little bit with my brother Steve, but also in the next episode in the series when we focus specifically on Roth IRAs. But let's start here. For retirees, somebody retires, they're going to need to tap into some of their nest egg for retirement. And what would you describe as the most common thing you're going to see, knowing full well that there's all different shapes and sizes and circumstances out there? But what would you describe as the most common kind of pattern?
Yeah, this is going to be intuitive for you as we go through, but the most common pattern that we've seen at the Nationwide Retirement Institute is, first and foremost, most folks want to do everything they can to take their Social Security as early as possible, right? So when we're talking about tax efficient retirement income, we're talking about income, and we know that there is a very predictable equation. Everyone wants to see, how can I take my Social Security as quickly as possible?
Okay.
Right, wrong, or indifferent, that's the number one thing. People want to take it as soon as they can. Now, the next thing that we know that they do is they go and they start to work on their non-qualified accounts, because they might be able to draw down on their non-qualified accounts and let their qualified accounts grow. Now, how do we know this? Required minimum distributions. Why do we have RMDs? Because Uncle Sam wants to get paid, and he doesn't want people to delay taking their money from their 401ks, 403bs, 457s, deductible IRA, so on and so forth. So the first thing we see is there is an equation. And if you think about this, just to play with the concept of taxes, right? Chris, answer this question for me if you would. Technically speaking, is it better for one to have a legacy where they're passing on non-qualified taxable accounts to get a step up in basis? Or is it better for one to pass away with a 401k or an IRA that is going to create an income tax situation to the heirs, which is more efficient from a legacy perspective?
The non-qualified account is more efficient from a legacy perspective.
Now, that is just an example of from a legacy perspective, but there's a lot of conversations that can be had with your clientele while they're actually still alive. For instance, maybe that equation of take your Social Security right away, go after your non-qualified, let all of your retirement accounts grow. Maybe there's a different way that could be massaged. And it probably starts with understanding the concept of income tax brackets versus capital gains.
Yes. So you read my mind, because I wanted to ask you, in thinking about this, there's some taxes that our listeners, retirees, when considering how to cobble together a retirement income, want to be aware of. So the two primary ones are ordinary income and then capital gains. Can you provide a little bit more color about those and maybe some examples of the interplay between those two that could be used in some simple, basic, common planning techniques?
Absolutely. The first thing that I learned while I was studying this was to better understand the standard deduction for folks that are over age 65 and older. You know, when one's in retirement, and Chris, by all means, correct me if I'm wrong, because you have a different sample pool than I do. But once one is on a fixed income in retirement, a lot of times the standard deduction actually comes into play more than folks trying to get write-offs above and beyond that point. Is that fair to say?
Yeah, I believe the estimate is somewhere between 80 and 90% of tax filers take the standard deduction as opposed to the itemized deduction. That number was always high, but it was driven even higher when the tax package was passed in the early days of the Trump administration. And the standard deduction, which you're going to talk about now, is so large that that's what most people most of the time end up using because it's to their advantage.
So it's to their advantage. So individuals that are filing a single or an individual tax return, a single person, the standard deduction is $14,250. Married filing jointly is $27,800. So of one's retirement income, right off the top, if you're married filing jointly, the first $27,800 are not going to be subjected to your ordinary income tax brackets. That's the first thing we would like listeners to start to understand. That's a good thing.
It is a good thing.
Very. Now, what's going to happen is there are going to be income tax brackets. And for the first $9,550 that one earns above their standard deduction, they will pay 10% on that bracket only. Okay, now that's if someone's filing single. If someone's married filing jointly, the first $19,900 will only be taxed at 10%. So one's marginal tax rate is the highest tax rate that they will pay on the last dollar they earned in retirement.
Right.
Okay. So people do not necessarily, if someone goes all the way up, and let's say that they're married filing jointly and the household is bringing in $100,000 in income that they're living on, okay, that will put them in a 22% tax bracket. That means that the very next dollar they earn, they will have to pay 22% in a marginal tax rate.
That's right.
Okay. Now, this is important because a lot of people in the public who don't know exactly how ordinary income tax brackets work, they would assume that if they're in a 22% tax bracket, that might actually be what they're paying in taxes. And that's not the case because they have to be brought through the individual tax brackets. Now, you, as a financial professional, part of what you do is you figure out how to put the pieces of the client's puzzle together where they may have a higher income, but you keep them in the lower brackets for tax purposes, bringing down their tax liability.
Yes. And listeners, what we're talking about is the tax brackets are what's called graduated. So in Steve's example, if you have $100,000 of income and that last dollar is going to be taxed at 22%, but the first dollar was taxed at 10%. And then you would have paid 10% on the first 19,900 married filing jointly. Then you would have had other monies after that that would be taxed at 12% on your way to monies that are taxed at 22%. So not all of the income is taxed at 22%. Some's taxed at 10, some at 12, some at 22, and it could go higher from there. So the trick in planning, Steve, you're exactly right, is to figure out opportunities when a client has brackets available to them or buckets, 10% tax bucket available to them. Do we want to fill up that bucket because 10% is a pretty good deal? And it opens up some opportunities to do some good planning for retirement income and maximizes wealth creation.
Yeah, that's exactly correct. And then when you compare that to the idea of capital gains, this is where I find the conversation gets very interesting. Okay. And when you tie the two together, you can start to give specific examples. So when we're looking at capital gains is the IRS's designation for things that are property or investment driven. So if one buys a stock, a bond, a mutual fund, so on and so forth, that's considered property, and that means it's going to be subjected to capital gains. Now, there are long-term capital gains and short-term capital gains. So if one holds an investment for less than 12 months, and then they liquidate that investment at a profit, their tax liability of short-term capital gains is going to revert back to their ordinary income tax bracket. If one holds that same investment over 12 months and sells that investment at a profit, then what will happen is any of that gain will be subjected to what's called long-term capital gains. Now, Chris, were you aware of the fact that when someone is in retirement, we're going to be looking at how much income they're making, as well as what the capital gain is to determine what their capital gains bracket is? Were you aware of that?
I was aware of that, and that's part of the statement that I mentioned earlier in our conversation, the intersecting of financial planning, investment planning, and tax planning.
Got it.
Because you can, in some instances, manipulate the interplay between those two to mitigate taxes. But
yes,
what we'll position to clients is that, listen, if we don't have, I'm not a CPA, I do not prepare taxes, but it's difficult for me to advise clients effectively if I don't have an appreciation for their tax situation. Otherwise, if I'm making recommendations that are often have a significant blind spot, especially when you're dealing with people that have, a few bucks set aside and are big income earners where they're in higher income tax brackets. And so, yeah, that's a very key part when we're making recommendations to people, Steve. And I don't mean to make this a commercial, but we want to be aware of tax situations. We want to work with their tax professional and coordinate efforts, because anytime we could mitigate taxes, we're helping the clients. We want to do it legally. We want to avoid taxes, which is legal, not evade them, which is illegal. So that's that intersection. And it surprises me, Steve, how many advisors are out there that don't take a look at all at the tax situation, because then I think they're making recommendations without missing some really important information. And it's hard to think that they're making optimal decisions if they have that blind spot.
And that's why the Nationwide Retirement Institute does exactly what we do. So keeping it on capital gains, if you have a retiree, a couple married filing jointly, and let's stay with that $100,000 mark. Okay, that's the income they have coming in retirement between their Social Security, let's say a pension, and spinning income off of their investments. Well, that will mean that if they have a capital gain, as long as the capital gain does not exceed $501,600, they're going to be paying 15% long-term capital gains. Now, the minute that they have a capital gain that pushes them over that $501,600 threshold, say they're selling a real estate property that was not their primary residence, so on and so forth, they will actually be paying 20% in long-term capital gains. But what I like to do is I like to make it easy, because if someone has, let's say, $100,000, and then they're thinking of selling off an investment. Now we can have a lot of fun, because if they happen to have different buckets of money, the question becomes, if someone is making $100,000 fixed income, that also means that they're in the 22% marginal tax bracket. So if they have a new expense, or if they have an investment they want to sell off, the question is it better to take it out of their qualified accounts, which is going to put them in the 22% marginal tax rate, right? But if they happen to have a little bit of diversification of money, and they have money that's in a non-qualified account, well, then if they're in the 15% tax bracket, the question becomes, is it better to maybe possibly sell off that non-qualified asset to save the taxes? Or is it better to just take the money out of the qualified account? And that's the beginning of the conversation, to give a concrete example.
No, that's perfect. And before we move on, I had a meeting with a client today that is an example of this. Recently retired. They're comfortable in retirement, but they're not mega rich.
Mhm.
Their income this year is going to be between $60,000 and $70,000, married couple. And they have some company stock, some stock of the company that he worked for. And I don't know what the basis is, but what we talked about in the call was there's a chance he might be able to sell that stock this year and book the gain.
Mhm.
And we're not sure how much it is. That's what our homework is. But book that gain, and they might be in the 0% tax, capital gain tax bracket this year. And then we talked about, and this is advanced stuff, listeners, but then they could even buy the stock back if they want. Because in the future, when they start tapping into their other retirement assets, they may be in a higher income tax bracket, or tax rates may be less friendly later on. So that's exactly what we talked about. Does it make sense to sell some or all of that stock, book a gain? If we could do that at 0% capital gains, why not do that? And we additionally, Steve talked about possibly doing a Roth conversion for the same reason. But we don't want to do both. We got to kind of put the puzzle together, to use your terminology from earlier in the discussion, to kind of figure out a good way to get some things done to save taxes, not just in 2021, but also in subsequent years. And that is a really valuable aspect of the role financial planners could play with their clients, or their clients could do it themselves. You just kind of have to pay attention and merge these different disciplines together to do proper planning.
And you have to really enjoy it. That's why we do what we do. I love what I do. I know you've been doing it long enough. I mean, this is your passion.
Yes.
For folks that like to geek out on it and they want to get their hands dirty, roll up their sleeves, no, everyone should always take a leadership role in their own financial planning, and we absolutely support that. But the other side of it is, if this is not what you absolutely love, we always recommend getting with a financial professional that is always working in the client's best interest, to let them do what they do best, geek out on this stuff, but also making sure that we're educating the client every step of the way, so they understand why they're saying yes to the decisions that are right for them.
Yeah, no, that's a great little commercial. Thank you. So in this planning, it's always helpful when we have different options available. And what I'm speaking about is different. I'm going to use the term buckets of money. I think the Retirement Institute talks about it more in the terminology of location, but I say different buckets of money. If you have taxable bucket, you use the term non-qualified, tax deferred, qualified money, again, like 401ks, as well as tax-free money. So can you talk a little bit about the importance? Because if you don't have different buckets of money or different locations of money, if theoretically, I know it's an extreme example, but if all the money was in one bucket or in one location, then a lot of the things that you and I are talking about, the stuff I geek out on in my profession, you're kind of limited. But can you talk about the importance of the diversity of retirement income sources, or the diversity of where your assets are?
Yeah. And, this was one of the brainchilds of Carlo Cordasco, the National Field Director of the Nationwide Retirement Institute. And I'm not sure, but he may have gotten it from one of our top wholesalers out of New York, a guy named Steve Mahalik. And it's this concept, everyone talks about asset allocation, right? Asset allocation, you got to have asset allocation. Well, what they started playing around with this was this concept of asset location versus asset allocation. For instance, and this is a little bit of a review, the taxable accounts, I call them non-qualified accounts. If you have a stock, a bond, a mutual fund that is designated according to the government and the IRS as taxable, well, then you're going to be paying your long-term or your short-term capital gains. Okay. Now, if you take that same stock, that same mutual fund, and you can take that investment and you can put it into a 401k, 403b, 457, a traditional IRA. Well, now, when you fund that account, the government gives you a tax deduction right there and then in the year you do it. When the money gets a return on investment each and every year, it grows tax deferred. And then when you pull the money out of a tax deferred account, it always gets taxed as ordinary income. Okay. Well, now what if we have a third asset location and we take that same stock, that same bond, that same mutual fund, but instead we park it in a Roth type of an account? Now, all of a sudden, when you put your money in, you didn't get a tax deduction. But if that same stock, bond, mutual fund gets a return on investment each and every year, it grows tax deferred. And then when you go to pull the money out, as long as you're playing by the rules correctly, the money then comes out tax free. And that's the same thing with health savings accounts. That's the same thing with taking cash value withdrawals or loans from cash value life insurance. So what ends up happening is, for folks that want to really roll up their sleeves and figure out how they can have a tax efficient retirement income plan, now they're going to start to look at the Roth type of accounts, look at things like certain types of municipal bonds, and possibly even if they have exposure to what's called a health savings account. Now there are ways that you might be able to, in retirement, be able to pull money from these accounts that are going to give you zero tax liability. And that can be very important.
Sure. So you have different sort of levers to pull, and each year with some planning, and we're not talking about 40 hours a week kind of planning, but with some appropriate planning, you could figure out which levers to pull, which places to draw money from in any given year to minimize the tax impact. And it's common, one year might be different than another year. And some people may say, it doesn't matter, I'm just going to do it. But I think the wiser way, what I would want to do with my money, what I do and will do with my money, is to try and implement a way to do what I want to do, but do it in the most tax sensitive way as possible. It's worth the time. And in today's environment, with Roth 401ks, Roth IRAs, HSAs, real estate has their own particular set of tax rules. There's opportunities if you have money in a diversified portfolio, that there are lots of planning opportunities that are often available, and it's a shame when they get overlooked. So the thing about this is, Steve, if I have listeners that are older, they're going to be in that old model you talked about, because older individuals, by and large, I am speaking in generalities, are going to have less money in Roth. Our ability to be flexible using Roths and even HSAs is a little bit more limited, because over time, more people are funding Roths, and between compound interest, ongoing contributions, and just time doing its thing, it seems like every year there's more money in these other buckets compared to 5, 10, 15, 20 years ago. So these planning opportunities are getting more intense, not less. Don't you agree?
Definitely getting more intense. Yeah, the more opportunities there are to do planning, the more complex it becomes, and the more exciting it becomes, because that means that there's a lot of room to be able to protect people, businesses, and futures with extraordinary care.
And it seems to me, and I imagine we'll talk about this in some of the future episodes in this series, and actually there's going to be a second 3-part series too with some other topics, but I want to speak to one of the observances I have, having been in the industry 29 years, is that there's a number of times where what the common sense default easy decision is also the one that can be the most punishing. So let me explain. The default for a lot of people, and you touched on this a little bit at the beginning of the conversation, the default for a lot of people is, I have money in my retirement account, and the old adage used to be, why take money out of something, pay taxes on it if you're not going to use it today? And that used to hold more water than it does today as an argument. But the default decision is, I'm going to leave that money for last because I don't want to pay taxes to Uncle Sam. But that could often, in today's world, be the damaging choice. But it's the easy one. It's the common sense one. But I think kind of the rules that we have kind of prey on that, either intentionally or unintentionally. Can you use an example and can you talk about how waiting to take money from your retirement account until you're forced to at RMD age, which is 72, as opposed to taking it out earlier, might be an improvement in your wealth creation and maintenance of your wealth because you can mitigate taxes? Can you talk about that?
Yeah, we can start on that. And I definitely recommend bringing this up with Doug when you have Doug on.
Okay.
The way he knows how to frame this conversation is outstanding. And I would submit that he's one of the go-to authorities in the entire company of Nationwide when it comes to this topic of tax efficient retirement income. He's outstanding. You know, when you're looking at the concept of RMDs, right? Once one starts to take their RMDs, it's because they hadn't been taking their money out of their account. Uncle Sam wants to get paid. And now all of a sudden you lose quite a bit of flexibility because your RMD is going to be based on life expectancy tables and things like that. All right. If one were to take maybe a little bit more of a mindful look at their tax situation with respect to financial planning and investments earlier on in their retirement, they actually have more flexibility at that point compared to the RMD, which is going to become very rigid. And again, if you listen to the way Doug will actually go through this information and the stories that he could tell, it's absolutely profound. Because at the beginning, right, you as the financial professional and the client, you get to determine a little bit how you fill up those lower and lower brackets. Once one gets to the point where they have to take their RMD, if they haven't strategically drawn down on that 401k or that retirement account, well, then all of a sudden the decisions get made for you and you lose your flexibility. Does that give you a little bit of color?
Yeah, no, that makes sense. And I will talk about that with Doug. I want to say, Steve, a thank you to you, the Retirement Institute, all of Nationwide, for helping me put together this series and allowing me to tap into this thought leadership that is very powerful. So thank you to you and your team in advance. I know I'm going to speak with a bunch of your team members over the next stretch as we put this series and the subsequent one together. So thank you very much. And listeners, if you want more information about me and my team here at Elliott Wealth Management, how we help our clients win with money, how we work with them on that intersection I talked about a couple of times on this episode, the intersection of financial planning, investment planning, and tax planning, please go to the website. It's elliottwealth.com. You could sign up for a complimentary consultation. So please check that out if you haven't done so already. And I'll be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint